When you hear the word stock, what comes into your mind? Is it that meme of the stonks guy? Or maybe it's a bit more technical. Nevertheless, stocks are one topic that seems scary to get into at first, but once you understand it, you'll be a stock expert in no time. So, let's get into it. First, I'd like to mention the New York Stock Exchange trading floor. It's a scene synonymous with stock investing itself. This is where traders meet in person to buy and sell stocks, find deals for their clients and employers, and yell tickets and prices across the trading floor. Well, this used to be how most trading was done back in the day. These days, you can do most of the work online. Advancements in technology have even allowed everyday individuals to take up trading in the comfort of their own homes to try and make some money. Despite the fact that trading involves stocks and other investments, it is often seen as a very different practice from investing. What you or I probably do when we buy or sell stocks, like being a trader, whether professionally or as a hobby, is different from being an investor. While you've probably heard of people making quite a bit of money off trading, it's still an area that most people are best avoiding altogether. Why? Well, we'll answer that question and more in today's video. Welcome to Modern Wealth, where we talk about almost everything financial. Now, if you look at the literal definitions of the terms, like investing and trading, you probably won't grasp the difference between the two. After all, investing is the act of spending money with the hope of generating some larger benefit or returns. In the future, while trading is the act of buying or selling investments, it's not very clear how the two differ. In fact, there is no technical distinction dictating what counts as trading and what counts as investing. But the terms are often used to refer to two very different approaches to making money from investments. An investor is someone who places their money in something they're passionate about and looks to profit from that asset growth over time. A trader, on the other hand, is someone who makes money in the short term by buying and selling stocks frequently. In other words, while one relies on a gradual appreciation, the other focuses on market volatility. Now, being a trader can mean a number of different things. Many companies actually hire traders to help them carry out their investment decisions. For example, an investment firm may decide they want to own shares of Modern Wealth, so they'll hire a trader to help them get the best price for the shares. For this video, however, we'll be focusing on traders who operate with the sole objective of making themselves money. There are two main areas wherein this practice differs, from investing in the timing of trades to the analysis of stocks for timing. As I mentioned, investing is typically a long-term strategy, whereas trading is more short-term. When you invest in a stock, you're betting that over time, the company will grow, either by expanding its asset base or its profits. You can invest in a company for as little time as you want, but generally speaking, you'll be aiming to sell the stock today. Aside from that, the basis of the price of a stock may fluctuate, with some investors trying to take advantage of that by buying when the stock's prices are abnormally low. But once the purchase is made, the focus tends to shift to the long-term movement rather than the short-term. Volatility trading, on the other hand, is the fast and furious approach. It involves buying and selling the investments to take advantage of short-term price swings. Day trading, for example, involves individuals buying and selling stocks on the same day, while swing trading expands the process to a few weeks, months, or sometimes even years. There are other styles of trading as well, but they all tend to fall under some incredibly short time frames. Sometimes, even making buys and sells within a matter of seconds, because some traders submit many more trades than investors and often cycle through many more positions. However, selling something shortly after buying it doesn't alone make you a trader. So how about the second point of distinction? First off, the analysis part is to understand how the analysis of a company and its stock price varies between traders and investors. We first need to explain the difference between a stock's price and its intrinsic value theoretically. The price of the stock only reflects the number of buyers and sellers trading that stock at that given point in time. Past the stock price, there's some intrinsic value or the true worth of that stock that probably only an all-powerful being would know. Over time, the price of the stock should track closely to this intrinsic value, as buys and sells play a large role in factoring company information known by the investors. But human factors like fear or greed might lead a stock's price to deviate from its actual worth from time to time. Within the world of investing, people take two approaches to this information. There are passive investors. They ignore short-term fluctuations in stock prices and look only to benefit from the rising intrinsic value. They do this knowing that even if they do buy an overpriced stock, they should benefit in the long term. Then, there are the active investors. As the aggregate market grows, active investors instead try to estimate a stock's intrinsic value so that they can buy the stock for less than its worth, allowing them to benefit not only from the rise in intrinsic value, but also from the return of the price to its intrinsic level. These two approaches vary from one another in the sense that they both generally depend on the intrinsic value of a stock. Increasing traders, on the other hand, only care about the stock price with no attempt to estimate the intrinsic value of their stocks. Indeed, many traders buy and sell stocks without even knowing what the company does, looking only to take advantage of the short-term swings or trends in its stock price for this reason. It's also highly common for traders to focus their analysis on technical indicators. These are measures and gauges that only take into account historical pricing information to help the trader determine whether there's a developing trend or pattern that they can quickly exploit. It's the graph and charts you imagine when you think of a professional trader sitting in front of their 4 screens, buying and selling stocks. Now, some traders do incorporate qualitative information into their research as well, but it is usually only to take advantage of a short-term shift that they're expecting at the stock price. For example, if a trader finds out that a company is announcing news tomorrow, they may decide to buy the stock with the belief that the company's announcement will be positive, leading to a jump in the stock price. In either case, traders generally only focus on snippets of a company's information rather than trying to develop a broader understanding of the firm's operations. As a little recap, those are the two primary ways trading differs from investing. It requires a very different mindset since it operates in a very fast-paced and highly competitive environment. Since we've talked about the two approaches and a little crash course on stocks, be sure to let us know your thoughts in the comments down below. And if you're enjoying the video so far, make sure to like and subscribe. Now, let's get on with the video. Some people would even argue that trading in stocks require a fair amount of bluffing. This was more so the case when traders used to talk in person about the stocks they wanted to buy and sell. Actually, even today, traders often try to hide their true intentions when they get into stocks. After all, if you can convince other traders that you don't want to buy something, you may be able to get it for a lower price, just like with anything else. All of this can make trading a very alluring practice for young investors. I mean, competition, fast trades, quick payoffs, it's got everything a young, steadfast, and highly competitive individual wants. With all the ads we see online of millionaires and their private jets explaining how they went from zero to hero with their $300 trading strategy, it probably seems like a fairly easy field to enter. But again, I can't stress enough that trading is a high-risk practice. Most traders put a lot of money behind their individual trades, sometimes even borrowing to leverage their returns. Unfortunately, this exposes them quite heavily to the short-term volatility of individual positions. It also requires a lot of effort. In time, many trades only end up yielding a fraction of a percentage, meaning traders are continually rolling their money into new positions. Honestly, when it comes to amateur traders, the truth is, there just isn't that much working in your favor with such a narrow time frame. You're often forced to make decisions on a mishmash of information, and when you consider that, you're competing with industry professionals with insane amounts of money, cutting-edge research, and even the best industry algorithms. If you were just like them, you can trade faster than you can say the word stop. Although it's just not a fair fight now, I'm not saying you can't make money through trading. There are people who make a full-time living from their homes with trading activities. In fact, some companies even offer salaried positions for traders like we mentioned earlier. There are definitely some merits to the field, but trading is a lot like playing poker. You can be very good at it, and indeed, some people do make a living from it. But there's a lot of chance involved with other great players at your table. The odds are often not in your favor, so any advisor will probably tell you that investing is the better way to go for the average person. You no longer need comprehensive research and holding over the long term. You're more likely to benefit from the broad growth of the economy and even the stock market as a whole. Yeah, you might not get the same rush as a triple levered buy on an out-of-the-money option, but that's probably for the best. After all, if you're looking for the rush of high stakes and not so great odds, you might as well go to the casino. At least there, you'll get free drinks. Just keep in mind that your trading venture isn't going to immediately bring you the success and fortune you were hoping for. But maybe you have your own business you're trying to gain traction with, or maybe you're looking to get your name or your work out there for people to discover. With that being said, do you think getting into stocks is for you? Let me know your thoughts in the comments down below. And if you found this video helpful, make sure to like and subscribe. Thanks for watching. And if you want to learn a few more tips and tricks to handling your money or your money-making skills, make sure to subscribe. We'll see you in the next video. Cheers!